Hello and welcome. Moss Adams is pleased that you joined us for today's session, Healthcare Accounting and Insurance Updates. Before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have a couple of great presenters with us today from Moss Adams. We have Haley Muela, Senior Manager, and Josh Lewis, Partner. Their bios and contact information are located in your webcast console. And now I would like to turn the floor over to Josh to get us started. Oh, Josh, I think you're on mute.
Thank you, Amy. And welcome everybody to the presentation. For our agenda today, we're going to start by going over some the updates from the authoritative GAAPs issuers, FASB and GASB. We're going to go over some non-authoritative accounting guidance updates from the AICPA and from HFMA, and also go over some issues that are going on or current updates and new standards in the audit and single audit space as well. So starting off with FASB, this sentence we have at the bottom here about the old FASs, it's actually been, I keep realizing that the accounting standards codification is pretty old now. It's been 14 years since a FAS came out. But for those of us that remember the old FASs, we didn't get them that frequently. They were usually very significant. They were long. They were very comprehensive. And in the last 4 years, the accounting standards updates that have come out to the codification, we've had 36 of them. And that took 12 years to get the last 36 FASs issued. So the standards are coming at us much more frequently. Again, 36 accounting standards updates in the last 4 years. Some of them are comprehensive, like the lease standard, and some of them are very pinpointed and very surgical in what they addressed. And the ASUs, the way it's set up, allows FASBs to issue that and have more direct guidance and for stuff to come out more frequently when there's emerging issues than the old standards. So they're coming at us fast. We're only going to cover the ones that we think are most applicable to healthcare reporting entities. And with that, I'm going to kick it over to Haley to take us through those FASB updates.
Thank you, Josh. I think we're covering about 6 accounting standard updates or accounting principles right now. The first one being the credit loss standard, or CECL. As you can see by the effective dates at the bottom, excuse me, it was already applicable and implemented for public business entities, but for all other entities, it is effective beginning with year ends after December 15, 2022. So 12/31/23 year ends, you're going to be implementing that this year as well as the others. Just some background, this was predominantly driven by concerns with financial institutions and how they were accounting for their allowances, especially with the global financial crisis. So it resulted in the current expected credit losses, or CECL model, if you hear that acronym. It pretty much is saying, you know, if you expect losses, you record those on day one instead of waiting for the probability of incurred loss to become more significant. So one way to think of it is all other entities would now be accounting for their allowance on their AR in a similar way to how healthcare entities traditionally have been doing it. So with that in mind, on the next slide here, it does affect all accounts receivable, contract assets, pretty much any assets that are not recorded at fair value. There are certain assets that are scoped out. They're listed here for you to refer back to. But policy loan receivables of insurance entities, a big one would be pledges or contributions receivable for not-for-profits. The standard scopes those out. The CECL model is not applicable to those. If you have loans or receivables between entities under common control, or if you're acting as a lessor, operating lease receivables are also scoped out. So what does this mean for you as a healthcare entity? Patient accounts receivable, it's really not expected to change how you're currently accounting for your allowances. Similar to implementing the revenue recognition standard a few years ago, topic 606, it's predominantly going to be financial statement disclosure impact, as the disclosures are going to be more lengthy, which I'll cover on the next slide. But with that in mind, you do need to be assessing your other miscellaneous receivables, other assets, again, not recorded at fair value. We've listed some of the more common ones that you could be considering. If you have held to maturity debt securities, the standard applies. Available for sale debt securities, it amends the existing impairment model, namely taking out language like other than temporary impairment. So if you do have this type of security, refer to the standard on how to account for any of those changes. If you have any loans or loan commitments that are recorded at amortized cost, the standard applies. Reinsurance receivables, if you're an insurance company under the scope of topic 944, again, you're scoped out from it, but with captive insurance entities and the like becoming more prevalent, the reinsurance receivables would apply for the CECL model. Then one final one to note is financial guarantee. So if you're guaranteeing loans for other entities, if you expect to have to pay on that guarantee at all, you would need to be accounting for that as soon as you have that information. So the financial statement disclosure requirements, again, this is where the patient AR will be predominantly impacted. As with implementing any new accounting standard, you'll disclose in the year of implementation the change in accounting policy. You will need to expand disclosures on your methodology used for accounting for your allowance for credit losses. That's the new terminology coming out. So if you use any certain data points, any key assumptions, you would need to disclose those. If you have any changes in your allowance for credit losses during the year, you would need to include the reason for making that change, as well as any impact that will result in the financial statements. Another area is credit quality indicators. If you're considering credit scores, anything like that, and how you're determining the allowance, that gets disclosed. Risk concentrations. Yeah, we kind of already had some of those disclosures if you were geographically concentrated in a certain area, or your payer mix. Those have previously been disclosed, but keep in mind that risk concentrations are needing to be disclosed. And then it leaves a very broad, the last bullet point there, other qualitative or quantitative disclosures. So Any other information that the users of the financials will need to understand your allowance for credit losses, that has to be disclosed. With that, we have our first polling question. After going through that, how prepared do you think your organization is on preparing for CECL implementation? Ready for it? B, need to consider for non-patient AR. C, thought we were ready, but have some additional considerations. D, not ready, going to need help. Or E, not applicable, not sure if you're GASB reporter. Got about 50% responded now, so let's keep getting those responses in. Amy, I think we're having a little bit of problem with the polling, but.
Yeah, so I just wanted to step in here. So most have responded, but if you don't see the polling question, you can hit F5 to refresh your console. They are located right on the slides that we're presenting, so make sure you have those open. We'll leave it up another 5 seconds or so while everyone does that. Make sure to hit submit. All right, here are the results.
Glad to see they're ready for it. It's about a quarter of the responses. Not applicable or not sure also is pretty high. So we would recommend looking at that standard in detail to make sure that you're considering everything. All right, the next topic that we're covering is the reference rate reform. This has been around for a little bit. It was not meant to be around for a very long time. But as the regulators keep pushing back, moving away from LIBOR and towards other reference rate, the standard keeps staying in effect until that period has ended. So the most recent accounting standard update has extended this guidance through December 31, 2024, in order to cover that transition period away from LIBOR. It's not really a huge topic. It's meant to provide some relief. So these are the main areas it would impact. If you are modifying an agreement solely for the purpose of changing the reference rate, you don't have to do certain reconsiderations. For example, leases, if you are changing your lease agreement just to move away from using LIBOR as the reference rate, that's not going to trigger a lease modification or needing to reassess the discount rate or lease classification. So again, if the only reason that you're changing an agreement, whether it's debt, leases, derivatives, or hedging, if it's only to change the reference rate, this is providing some relief for the accounting. Lease accounting, I'm sure we all thought we were done with implementing lease accounting, topic 842. However, this was a very wide-reaching and big change for a standard. So it's still getting some tweaks, and as there's feedback from how implementation is going for the regulators, there's still guidance coming out here and there. The most recent accounting standards update issued related to lease accounting is 2023-01, and it's very specific to common control arrangements. So those would be parent-subsidiary relationships or common ownership relationships. One of the provisions of this accounting standard update is that it adds a practical expedient for private companies based on feedback that it's difficult to determine what's legally enforceable in common control leases. So the practical expedient If you have a lease agreement, you get to account for the lease within the terms of that agreement when you're determining whether a lease exists or the classification of the account and the accounting for that lease. However, if there is no written lease agreement, you cannot apply this practical expedient. You would still need to be determining whether it is legally enforceable. The other area that it addresses is leasehold improvements and accounting for those on this type of arrangement. So leasehold improvements associated with common control leases, you're required to amortize those leasehold improvements if you're the lessee over the useful life of those improvements, regardless of the lease term. And then as long as you are controlling the underlying asset for that lease arrangement. This accounting standard update is effective beginning with fiscal years ending after December 15, 2023. The next one that we feel is relevant for healthcare organizations, joint venture formation. So one of the accounting standard updates from last year. It is effective for joint ventures formed on or after January 1st, 2025, so starting next year. The old guide, this is specific to accounting for contributed assets upon formation. So historically, there was not really any specific authoritative guidance on how to account for this. Either companies would measure at fair value or they would measure it at the carrying amounts at the date of formation of the entities that were contributing those assets. So the new guidance, when you're forming a new joint venture, everything that's contributed is accounted for at fair value on the date of formation. And then if you have existing joint ventures, you do have the option to go back and retroactively apply the guidance if you choose to do so. Another one, this one was issued toward the end of last year, accounting for and disclosure of crypto assets. So this is the first authoritative accounting guidance related to crypto assets. The guidance is saying that you should record those at fair value, and then any changes to the fair value will flow through net income each reporting period. It is effective for fiscal years beginning after December 15, 2024. Overall, just high level, it should be very evident and very clear to the users of the financials that you have crypto assets. So balance sheet presentation, you're presenting them separately from other intangible assets. And then similar on the P&L or statement of activities, presenting those changes in fair value separate from other intangible assets. And if you caught it, it does say intangible assets. It was determined that crypto assets are a form of digital money and don't have any physical substance. So with this one coming out, they're saying the most appropriate classification is an intangible asset. There's also other disclosure requirements that are coming around with this accounting standard update, but we're not covering those right now. So refer to the standard if you have or are planning to enter into these types of transactions. Income taxes, so any for-profit healthcare or anyone where income tax reporting is applicable. This was the last accounting standard update issued in 2023. It's very much disclosure driven, changing how income taxes are disclosed. There are there's additional disclosure requirements if you're a public business entity. We're not going to go into all of those ones today. We're just covering some of the main ones that are more applicable to all entities if you fall under topic 740. So the main takeaway is disaggregation and kind of describing where the taxes are originating from. So there's a lot of words on this slide. Again, you can refer back to it, but disclosing amounts of income taxes paid, disaggregated by federal, state, and foreign. And then if you have any individual jurisdictions, so if you do business in multiple states, if the amount of income taxes paid for one of those jurisdictions is 5% or greater of the total taxes paid, you're going to be presenting that separately. Income and loss from continuing operations disaggregated between domestic and foreign if you do business internationally. And then income tax expense, disaggregated by federal, state, and foreign again. So additional disaggregation. There are a couple of reporting requirements that have been eliminated. So you're no longer needing to disclose reasonably possible changes in unrecognized tax benefits, and then no longer disclosing cumulative amounts of any temporary differences that resulted from current exceptions in the current guidance. So this is applicable for public business entities beginning after December 15, 2024, and the following year for all other entities. Again, there are additional disclosure requirements for public business entities that we didn't cover, so refer to the standard on this one also. That was it for the technical FASB updates. For anyone that isn't aware, before accounting standard updates are issued, the FASB does release them for comment, and they do track any projects that they currently have on their website. Won't go into the specifics, but there are 2 exposure drafts that are currently open to the public for comments. Both have comments due in March 2024, so if you feel inclined to go through those and leave any comments, we've put a URL down here, so the FASB projects website. Again, you can go there to see how to submit comments and also keep track of current things that the FASB is looking at. These are not an exhaustive list, but this is some of the current FASB projects that they are working on. These are either past the phase of comments or they haven't quite reached that point yet. The only one that we will highlight for today is the 3rd bullet point, accounting for government grants. Historically, for-profit entities haven't had guidance on how to account for government grants. There's just been guidance released on how to disclose that. So if anything comes with this current project, for-profit entities would have authoritative guidance on how to account for government grants. The next polling question, of the FASB standards that we covered here, which ones do you anticipate your organization will be spending the most time preparing for? Do you think it'll be CECL, the first one we covered, topic 326, joint venture formations, crypto assets, if anyone has already obtained crypto assets or planning to, income taxes, other, or you're a GASB reporter, or not applicable? Okay, poll is closed. So pretty even spread. Seems that a lot of entities are still not in with the crypto assets yet. So maybe as that becomes more commonplace, that will change. But this is about what we expected on the results. And with that, I'll hand it over to Josh for the GASB update.
Thanks, Haley. So GASB issues their standards much how those old FASs were when we first got into the FASB discussion. These are a list of the ones that have come out since 2020. It stretches over here over this slide and the next slide here. Similar to FASB, we're going to cover the ones that we see are most impactful to healthcare entities that report as GASB entities. For the FASB entities that are on the presentation and attending here, always good to pay attention to this area too. If you're benchmarking yourself against a hospital district or another GASB reporter, it's good to know some of the nuances and differences in the accounting between the FASB reporters and the GASB reporters. All right, we're going to cover three right out of the gate here. And for those GASB reporters that are on the call, I'm sure GASB 87 is not, you're over and done with that one. You're already dealing with it. It's been implemented a while ago. The lease standard, GASB's version of the lease standard. We bring it up here because these three standards are more interrelated. And for the June 30 year ends that are GASB reporters, you've probably already implemented 94 and 96. For the 12/31 year ends, being just after year end, I'm sure you're dealing with it right now and making sure that your current financial statements for 23 are going to have this piece in there. But essentially what happened with the way these interrelate is if you have a contract in place to use an asset, to get rights to use an asset or control an asset for a long-term period of time, similar to if you're thinking of it from the GASB 87 lens, all of these are related to trying to build the transparency in the financial statements and have liabilities and assets on your balance sheet so that users of the financial statements can see the right to use those assets in the future, and then the lease obligations at a present value of what you're going to have to pay going out. GASB 94 covers public-public partnerships or public-private partnerships. That's what the PPP stands for there. And then GASB 96 is for IT assets, subscription-based IT arrangements. And so those SBITAs were specifically scoped out of GASB 87 and treated a little bit, had their own standard, but much of it, we'll go over that one a little bit. But GASB 96 is much like 87 in what it's trying to do. GASB 94 kind of covers the stuff, those types of agreements that 87 doesn't cover. So it's split into three standards, but really trying to cover any of those types of arrangements in order to get those obligations, the present value of those obligations on your balance sheet, and then the offsetting assets to go with them. They interplay with each other a little bit. So I think the biggest takeaway on these three is if you have an agreement that you think feels like a lease or similar to a lease, we've got an obligation to pay over a period of time, and we've got an asset to use for that, is looking at these three standards and figuring out which one applies. For healthcare organizations, we think GASB 87 had a big impact for the leases, and we're seeing not quite as big of an impact, but a decent size impact from GASB 96 on the SBITA assets. GASB 94, not so much. We think that one for healthcare GASB reporters is going to be a little more rare that you come across it, but it's something else to be aware of. It's kind of like a catch-all if it doesn't hit one of those other two, so something to be aware of. So GASB 96 being implemented if you're a June 30 or 9/30 and you've already issued, you already have this consideration built into your financial statements. If you're 12/31, maybe still working through it right now. Again, very much like GASB 87 in terms of how things are treated. GASB 96 also talks about some of those capitalization of expenses related to similar to internally developed software, where I've got implementation stage costs. Can I capitalize? What costs can I capitalize and not? Similar to if you had internally developed software. So that's something else that's covered in 96 that's unique to SBITA compared to the leases in 87. But there's also considerations around the term of the agreement. So a perpetual software license, it's considered you purchase the license, for example. But one unique one is if you have a license that automatically renews every year, similar to a lease, you need to look at it and say, well, how many years do I think I'll actually be in this agreement? It doesn't get me to short-term, a short-term agreement doesn't get me out of that. If there's a perpetual automatic renewal, you need to look at that and build that in as you think about all the future payments. So some considerations there. If you have SBITA, again, given the implementation timeline, most people have probably already started looking at this, but it is complex. There's a little bit of differences compared to the lease standards related to control and considerations like that, but a pretty impactful standard, knowing what IT, how much expense and payments are related to IT within healthcare organizations. All right, next one here is GASB 99. And so the omnibus standards, which come out from time to time, because GASB doesn't doesn't work like FASB in terms of those ASUs coming out that can be very short, narrow, and focused on one little thing. When they have those types of things, they basically conglomerate those, pull them all together, and issue one standard as an omnibus that just covers a whole bunch of different areas, but only gives a little bit of guidance or extra guidance or clarification on particular areas. And you can see those three standards we just talked about are three of the categories that were in here. So the SBITAs, the public-private and public-public partnerships, the leases, giving some more guidance on that. And leases is an example that already been implemented, similar to FASB. GASB's reassessing what worked well, what didn't, where do we need more guidance. And so in this omnibus, if you're looking at the lease components, you'll see they'll talk about, here's one specific area around lease terms, variable lease payments. When you apply this paragraph of GASB 87, think about these things. So it gives some additional guidance related to standards that are already out there. I'm not going to go into all the details of this one, just know the categories that are included. So if you have any of these areas, it's good to jump into GASB 99 just to see. It's not a big overhaul to anything. It's really more about additional guidance to stuff that standards that have already been issued. All right, GASB 100, accounting changes and error corrections. If for those who have been reporting or using GASB for quite some time and remember GASB 62 when it came out, this is the standard that took all the old FASB and AICPA guidance that we were using in GASB because we didn't have GASB guidance to use it, and it codified that and brought that all into the GASB framework and made it authoritative GAAP. And it covered several different areas of accounting, leases being one of them, back the old style of accounting for leases. This standard is superseding the part of GASB 62 that's related to accounting changes and error corrections. So it's giving guidance on accounting changes, as well as breaking that into three categories of what accounting changes, what type of accounting change is it? Is it a change in accounting principle? Is it a change in accounting estimate? Or is it a change to the reporting entity itself? And then also as a second component is the error corrections, not an accounting change, but an actual correction of an error, and gives the guidance for that. This is all related to this will all come. So if you have if you're a June 30 reporter and your 2023 financial statements, if you have a change to an accounting, if you have an accounting change or an error correction, it will impact your 2023 statements. And then September 2023 reporters and December 2023 reporters. Just a quick kind of overlay of how this works. Again, the first three lines on here are all part of those accounting changes, and then error correction as its own at the bottom. A couple things to point out on here. The change in accounting principle, most frequently when we see this, it's because it's the implementation of a new accounting standard. And oftentimes those a GASB standard will tell you how they want you to implement that or how they want you to report the change from the previous guidance to the new GASB standard. In those cases, the standards themselves overrule the requirements in GASB 100 here in terms of how that gets reported and disclosed. This is to fill in the gap when maybe that's not covered by the standard doesn't have a specific way they want you to address it. I think we might find that they put less guidance for transition in the GASB standards going forward because they want, because this now covers it. It's something more up to date, more authoritative, and only if they want you to go away from this will they give you some additional information or different types of guidance on how to implement and report that change in accounting principle. I'm going to go to the next slide here on GASB 101, compensated absences. This is one area where we do expect there to be some change in how things get measured. Most commonly, what we see for accounting for compensated absences is what would get paid out upon the liability is reflective of what gets paid out when the person leaves. So maybe an accrued PTO is recorded, but the accrued sick leave doesn't because it's a use it or lose it type of situation. But what we're expecting on this standard when it comes into play is that there will be an increase in liabilities related to compensated absences because of the component here, a few bullet points down on the left. If it's more likely or not to be used or paid off in the future, and that can be by cash or by some other settlement means. but that's going to drive some additional recognition. So sick leave that you wouldn't get paid out if you left, so we haven't recorded it as liability in the past, may now be accrued because you say, well, it's likely they're going to use, typically 80% of the sick leave gets used at some point in the future. It's been earned in their bank as of now, so we should have a liability as of now looking forward. So we do expect this to result in probably some higher liabilities for some GASB reporters. There is a modification to the disclosure requirement. You can see that bullet on the right-hand side here. For those, oftentimes we don't see this disclosure made for healthcare entities because the accrued PTO or accrued compensated absences is immaterial. But sometimes we do see it. It is material and it's in there, and that's a roll forward of that liability in the footnotes. This is to make the roll forward a little bit easier. It gives you the option of just reporting the net change instead of grossing up the increases in and the uses of that compensated absence liability. There is, I apologize, one typo on here on the effective date. It starts with June 15th. This should be beginning after June 15th, 2023. So if you're a June 1st reporters that will have to follow this are June 30, 2024 reporters, which means starting July 1, if you're a June reporter, this will be in place. So some may do it as a year-end conversion, but if you want to implement this at the beginning of the year that's effective, you would start as a June 30 reporter again on July 1, 2023. All right, GASB 102 on risk disclosures. So anybody who has been at a GASB reporter knows that there's lots of disclosures. The investment disclosures are very significant about different types of concentrations and risk disclosures. And so this is getting towards adding some more risk disclosures. Again, many of the GASB standards are written thinking about a city or a county government and just trying to make the users and the residents and citizens know everything they can about what's going on with the organization. And then business type entities like district hospitals or university hospitals that follow GASB get to then apply this to their financial statements as well. So this is really about disclosures around concentrations or constraints. And the definitions are up here of a concentration constraint. These are examples in GASB 102 of what falls under each category, but it's not an exhaustive list. Each one of these, there can be much more that could fall under this. So you'd want to follow those definitions. And essentially, you have to disclose these risks, these certain risks here that are covered either as concentrations or constraints if these three criteria on the left are met. So it's known to the government prior to the issuance of the financial statements. The constraint or the concentration makes the reporting entity vulnerable to a substantial impact, and that the events that could create that substantial impact have either occurred, they've begun to occur, or they're more likely than not to occur within 12 months of issuance. And that's of issuance. So if you're a December year in and you're issuing your financial statements in April, that means you look all the way to the next April, not just to the end of December. So this, the common areas that fall under those definitions that we see that get disclosed are similar to what we see on the FASB side. It could be a payer concentration within AR, within revenue, maybe a geographic concentration. But this one is really around, is there going to be a substantial impact? And has that whatever's going to cause that impact has begun to occur? I think the other one that we see sometimes is a collective bargaining agreement. So if you're in a CBA, maybe your nurse union, you're in negotiations, there's potential strike or different things like that. This would be the standard that would give you information about how to disclose and what should be reported related to that. And this is beginning, you got some time on this one. This will start with the June 30, 2025 issuances. This one is pretty new. It's right off the press. The standard just got issued in December. All right, the GASB implementation guide. I'm not going to jump into much detail here, but the implementation guides are authoritative GAP from GASB. They're written, if you've never been in them, they're question and answer format, and trying to take actual questions GASB gets on how to apply certain components of a standard in a real world circumstance. I have this situation, if this is going on, how do I apply this? And they give the answer to that. It's very helpful to go through. They don't issue one, they issue one most years, an implementation guide, but not every year. The most recent one It's 2023, they had one issued, and these are the areas that it covered. So if you've got questions about leases or SBITA or the new GASB 100, your questions might be questions that other folks have asked. And if you go into the implementation guide, you may find answers to them there. All right, with that, we're on our third polling question. And it is, which GASB standard do you anticipate your organization will be spending the most time preparing for? The public and private accounting, GASB 94, the SBITA, subscription-based IT arrangements, GASB 96, the compensated absences, accrued PTO and sick time and so forth, and GASB 101, the certain risk disclosures, again, that just came out. We're all digesting it. It's only a month old now, of GASB 102, or you don't have to follow the GASB standards because you're a FASB reporter, or just not sure which one is going to take the most for your organization. All right, so a lot of FASB reporters. I'm sure some FASB reporters are happy to see that they don't have to apply the GASBs, as well as maybe some GASBs happy they don't have to apply some of the FASBs. But a little bit of a spread here. I think that makes sense. I don't think any of these are super significant. It's not as big as like a GASB 87 was, as far as the overarching and economic impact to your financial statements. So the widespread here is what I'd expect. It kind of depends on your specific situation of your organization. All right, we're going to go quick through this, but recent AICPA guidance related to accounting. So the AICPA has a healthcare expert panel that does a bunch of different things. I think the biggest one to be aware of right now is they help with the audit and accounting guide that comes out for healthcare entities. If you've never used that or looked at it, referred to it, I highly recommend it. Again, this is non-authoritative, but it helps you assess the FASBs and assess the GASBs and how they apply. And there is a significant update that will come in the 2024 accounting guide for healthcare entities. And that's related to accounting, is Chapter 13, accounting for managed care contracts. And really what the expert panel in the ICPA are looking at with that is all the risk-based contracting and different things like that, those risk-based arrangements. We've always been focused on fee for service in terms of that's been the most significant component of revenue and where most of the accounting guidance is pointed to. So they want to give some more additional guidance in that other area of thinking about risk-based contracts. They also put out TQAs that come through. So these are the last few. They don't come out often, as you can see on the dates here, but the middle one here on the CARES Act provision specific to healthcare entities. So this was about how do you account for, the government grants that you're getting. As Haley mentioned earlier, FASB doesn't have guidance for the for-profit entities. So this was saying, hey, not-for-profits, you got your guidance. For-profits, here's a few different ideas. Since you don't have guidance, authoritative guidance, but here's a few different ideas of what to apply. So it was helpful information there. Again, this whole 6400 topic is specific to healthcare entities. In addition to the AICPA, HFMA puts out information as well, also non-authoritative, but both the AICPA and HFMA are looking to kind of plug holes where FASB or GASB is not putting out very specific healthcare guidance, but it is a significant issue to healthcare entities. The one I always think with HFMA was when they had the meaningful use dollars coming out, and how do you account for that? What's the timing look like? Am I matching it up with how I'm using the software that I'm using to accommodate or accomplish those goals? So they put out some information like that as well. Some of the stuff doesn't come out too quick. The most recent position statement is all the way back from 1997. But the most recent thing they put out was actually just less than a year ago in April about assessing reality in healthcare financial information. And this was not a super long white paper, but basically trying to give education to users of financial statements about, you have GAAP financials, you have your Medicare cost report, You have your 990 tax return. They measure things different ways. And, if you got to understand what the differences are and that sort of thing in order to have understanding about what is the financial picture for this organization I'm assessing if you're looking at all three of those different areas. All right, from an audit update, I'm going to go through these next few slides real quick, basically just saying we've got a lot of new statements of auditing standards that have been sent our way as auditors over the last couple of years, 142 through 148. I told you I was going quick because most of that is an impact to your auditors. Most of that is stuff we're doing in the background, the way we document, the way we staff and monitor our engagements and the different QC stuff we do. But if you're a healthcare reporting entity, what does it mean to you that all these new audit standards are out there? And really what it means is you might get more questions on some of those areas that they're pointing us to. So estimates, accounting estimates, more rigorous audit procedures done around accounting estimates, whether it's the understanding of them, the assessing of how volatile they are, different things like that. With that, asset impairment as well, that kind of factors in with the audit estimates or accounting estimates. The biggest one, I think, though, is this one on the bottom. I've been, I know the FAS comment at the beginning already dated me, that I've been around for quite some time, but in my over 20 years of being an auditor, the IT component and how we assess IT and how much time we spend looking at IT and the types of procedures we're doing as auditors has continued to increase over time. And I think it will continue to move that way as the understanding of how everything that we're getting out, everything that's feeding the financial statements in the end is processing through different IT systems. And so it's important from an auditor's perspective to really understand that. And so that you as the auditee is going to probably get more and more questions as we continue to give ourselves more guidance about what we need to be doing as auditors to walk through that. And with that, I'm going to kick it back to Haley for a single audit update.
All right, thank you. I think we're all aware that there's been a lot more government funding going around the past few years. So single audit update, not typically something we put in a accounting and auditing update, but just since it's on top of mind for everyone and there's still federal dollars going around, we're going to cover it for the last part of the presentation today. Provider Relief Fund is where we're going to spend most of the time talking, so not going to review this in detail. You can refer back to it. But this is the most updated portal reporting period summary from HRSA. As you can see, they've added periods 7, 8, and 9 for Provider Relief Fund. From what we've heard, there's not really a lot of funding coming out of those, but just something to be aware of. And then this is just a simplified way to look at it from single auditor if you're a for-profit entity from that perspective. But based on your CFA date, these are the PRF reporting periods that you would be including. So the 12/31/23 audits are going to be the first ones that are reporting period 6 if you happened to get any. The lime green at the bottom, the guidance has not been released on those. We are estimating based on the patterns that we've seen on the previous reporting periods for the CFA. So be on the lookout for that if you happen to be one of the entities getting some of the later provider relief funding. Provider Relief Fund audit results. So we put this together from the new Federal Audit Clearinghouse website. So some of the more recent single audits, again, the for-profit entities don't need to submit to the Federal Audit Clearinghouse. So these are just single audits. But as you can see, the Provider Relief Fund is still having a lot of findings, with 30% having material weakness, significant deficiencies, 10% question costs, and still having modified opinions. Josh, if you want to contribute anything here.
Yeah, so I had, I guess I'll call it the pleasure, but the first 292 single audits that were submitted with findings on PRF, I actually went into the Federal Audit Clearinghouse, pulled all those down and read through them just to see what kind of comments they were regardless of the category they fell in here. And there were a whole lot on the calculation of lost revenue, that the calculation just wasn't done correctly, done differently. A common one was people were electing option 2 and PRF reporting, which was we're using budgets that were not approved prior to the cutoff point in March 2020. So different things like that. And then another large category was that there wasn't the proper use of the COVID expense. The COVID related expenditures weren't correct. Either they weren't tying back to support, or there were expenses being included that didn't qualify, those sorts of things. And then kind of the third big bucket, general bucket, would just be general controls. People didn't have controls over monitoring the PRF program or building the schedule of expenditures of federal awards for their single audit. Those last two, very common, because most of our clients, some of our clients that are FQHCs or tribal health facilities, they're doing a single audit every single year. But many of our other clients, like several acute care hospitals as example, they hadn't been through a single audit for several years, if ever. So it was something brand new to them. So some of those general controls about how you monitor this program and different things like that were there. And as we all remember, that guidance was coming out late and kept changing back and forth, so that the feds didn't make it easy to try and follow the PRF reporting requirements. But I think the big thing on that, of all those different findings that were coming out, was the vast majority, it was about, again, nearly 300 that I read, the vast majority also concluded in the single audit that, hey, there's no money to pay back related to PRF. Yeah, they didn't calculate their lost revenue correctly, but there was way more lost revenue and COVID-related expenditures to eat up all of the PRF money that came through for this entity. So most of them were reporting that at the same time, saying, yeah, technically this wasn't done correctly, but it doesn't really change the result of whether XYZ hospital keeps their funds or pays them back. Go ahead, Haley. Thanks.
Thanks for that input. So what to expect for upcoming single audits? As you can tell, COVID-19 programs will continue to need auditing, not necessarily directly related to healthcare, but there is funding coming down now from the Infrastructure Investment and Jobs Act. The higher risk classification for Provider Relief Fund and other forms of COVID-related government funding, it continued in the 2023 compliance supplement. We haven't seen any indications that that higher risk classification is going to go away, but that hasn't been released for 24 yet. We'll cover it in the next slide or so, but there is increasing federal focus on oversight of these programs. And then, as Josh mentioned, with a lot of entities getting single audits for the first time or infrequently when they haven't historically, there is stress to the single audit system. And this is just a proposal, but kind of interesting. The OMB has proposed increasing the threshold for needing a single audit from $750,000 up to $1 million. So again, that isn't final, but something that they are looking at doing. And we have our last polling question now. How would you describe your experience with single audits? You're an expert, done this plenty of times. We're experienced a single audit in the past, but do not have to do this annually. You're new to this. PRF created the first requirement for a single audit. None. You haven't expended over the $750,000 threshold, or it's just not applicable to you. Or, you may have a single audit requirement, but didn't know that you have to have one done. Got about 60% responded. So if you haven't responded yet, make sure to do that quickly. Okay, quite a spread. Yeah, quite a spread. So with the one in the middle, new because of the PRF one, that is what we've been seeing. So, okay, to wrap up the presentation, we mentioned earlier that there's more federal oversight on these programs. So not only do you have single audits or the for-profit entity equivalent, but now HRSA can also look at provider relief funds and do their own audits. They have understandably a lost revenue focus, needing to understand how the revenue was recorded. If you had any one-time adjustments, do you have support for that? And then expenses, just highlighting the last bullet point, they are looking at controls over whether you're tracking that you're not double dipping. So if you're getting multiple government funds in, that if you claim an expense for provider relief fund, that you are not claiming the same expense for additional government funding.
And I think one other thing to note on the HRSA audits too is that the OIG is actually starting to do some audits as well. The only one they've released right now is related to community health centers and FQHCs. They pulled about 30, trying to get a geographic monetary spread and stuff related to the COVID funding that went through the health centers program, the additional funding that went through there. And they found issues, the OIG did, with 17 out of the 30 that they had on there. Some of them were unallowable costs. It was relatively lower number, 787,000 of just costs that should not have been applied to those funds. And then an additional 15 million that they thought might be wrong, that was mostly around how salaries and benefits were being allocated into that program. And the biggest culprit of that being using budget to do that allocation instead of actual. What's really interesting on that is that the OIG and HRSA do not completely agree on the results of that. HRSA is actually arguing that there was more flexibility allowed in the middle of COVID and what was going on, where the OIG is taking a harder stance. So it's interesting to see argue, you could interpret that as HRSA being an advocate on behalf of the health centers and the FQHCs against another component of the federal government, which is very interesting. But we're expecting to see some more of those from the OIG, where they're going to pick different segments of healthcare providers and kind of say, I'm going to pull a small sample here and see if I can find anything about maybe how they used the PRF or how they used other funding coming out of all the different programs that were there at the time. And we're out of time for questions. I know some have been submitted. If you've submitted a question, we will respond to you via follow-up email. So with that, I'm going to turn it back over to Amy.
All right. Well, thank you, Haley and Josh, for a great presentation today. And to our audience, if you have further questions or comments, please reach out to us and we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Haley and Josh directly. Their contact information is in your console as well as in the slide deck, which you can download now from the handouts window. Also, I do want to mention an upcoming webcast on February 6th, which is Tax Strategies and Trends for Healthcare Organizations. Clicking the image in the upper right-hand corner of your console will take you to more details and registration. So hopefully you can join us for that one as well. And then if you met CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. And finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. And again, thank you for joining us. Take care, everyone.